everyone, and welcome back. My name is Greg Furman, and this is the Forex Weekly Outlook for the week of May the 9th, 2016. Now, a busy week this past week. We've had the non-farm payroll. We've come out of that. So let's have a look at what's happening with the dollar, and more specifically, the non-farm payroll number. So when we look at our payroll numbers here, the first thing we want to look at is to always go to the U6 number, guys. The U3 number is the headline number. It's the official rate, but it doesn't carry the kind of weight, in my respectful opinion, that the U6 and some of the internal components of that report do. So when we look at this, we can see in 2016, we started out at 9.9 million still unemployed. We've gone from 9.7 in February to 9.8, back up to 9.8 in March, and then back down to 9.7 for April. So we're moving in the right direction. Now you're going to hear a lot of things that was not a good report. It was the worst report since last September of 2015 or something along that line, what these pundits are saying. But we really want to look a little closer at that and see if it really was a negative report. So when we look at one section of the report that I'm going to point out to everybody, the average work week for all employees on private non-farm payrolls increased by 0.1 hour to 34.5 hours in April. That is a positive, and that is an economics 101 here, guys, where basically what that means is that the work week is extending. So businesses are picking up. The recovery is fully in place. So are we going to get a June rate hike? Probably not. But it doesn't mean that this was a weak report. It was actually a very decent report, and it's in line with the recovery since 2008. So when we look at the dollar index, not surprisingly, the dollar index has been rising this past week, and it's been moving up, even though the euro for some part of that was moving up also. But what I want to point out is that when I look at pattern recognition, we can see that I've drawn a line here off of about May the 14th, 2015, and that comes into precisely where we are right now. So very interesting, and we can see that the dollar basically rallied from this point on in 2015. It was basically trending down, but then you can see we had a series of significant up moves with basically as we moved into December, that was the strongest month, which of course was related to a rate hike. Now we are probably going to get a rate hike here this coming December also, so this pattern could very well repeat itself. So on the dollar index, we want to watch this 94 level very closely. We've closed the week at 93.88. We're right on this level. So once we understand that seasonality of trade, and we look a little closer at that report and kind of ignore some of the news outlets and media websites that, they're just talking about the negative aspect of the non-farm payroll report, when in actual fact that's not true. It was actually a decent report based on the evidence that I've provided here in this particular webinar. So we look at our key vantage point level. Our key vantage point level is 94.04. We need to push above this and get above this. I believe in the next week or so we will do that. Once the major players look closer at that report, they're going to see that it was actually positive, not negative. So keep an eye on that. Our neural index is already picking up on these gains. Our predicted short-term difference pointing higher, our predicted MACD crossing the trigger, and our predicted RSI 51.2. These are all positives that VantagePoint is picking up based around those 30 other correlated markets that it looks at when it does its forecasting. So again, this is still the fundamentals, and the intermarket technicals are kind of lining up here for a dollar move to the upside. Now, for that dollar to move to the upside, guys, let me be very clear. We need these equity markets moving up. You can see we've got a long green bar from Friday that the equity markets had a positive reaction to the non-farm payroll number. I anticipate that they will build on those gains by Tuesday, Wednesday, Thursday of next week. Monday is always a very difficult trading day. What I recommend to my own direct clients is stand aside on Monday. Just let the dust settle a little bit from this payroll number, and let the market digest what the real number from that report is. So right now, in my respectful opinion, we need to stay above the 2030 area on the S&P 500. If the S&P 500 starts to rally, the dollar will rally with it. We can see the neural indexes pointing higher. We're above the zero line on the predicted MACD, and our predicted RSI is recovering from heavily oversold territory. That would, of course, also apply to the DAX. We can see that the DAX is also had a big move up on Friday. And I believe that to be consistent with the intermarket correlation the dollar index has to basically the DAX 30. So that would mean the euro moving lower. We would look for that to continue. Now with oil, I don't anticipate a lot of gains here in 2016. I think probably $50 a barrel, and its high period is going to cap it. But right now, the key vantage point level 43.54. Now, if oil continues to push up a little bit, it actually has a positive correlation to the dollar right now, to about an 80% correlation. So if oil moves up with the equity markets, that should again fuel a US dollar rally by midweek. Nothing is guaranteed, but if we look at the intermarket correlations, we look at the report, again, it's not really a negative report here. Now, that should have a negative effect, not a positive effect on gold if those equities start to move, because that would tell me that if the S&P is moving up, the DAX is moving up, the Nikkei is moving up, the global equity markets in general start to move up, then it's basically the US dollar is going to have a positive outcome from that, and that's going to hurt the euro here. Okay, so every time the euro is supposed to go up, it goes down, and every time the euro is supposed to go down, it goes up. You'll remember just a few short weeks ago, the major pundits were saying we're supposed to be at 108 on the euro here, down at least 110. We actually went to 115. So the intermarket correlations are driving the major players here in the currency and the commodity markets. So when we look at the euro, we can see we actually did not make a new swing high here. We have a new trend line coming in at about the 116.40 area. The lower end of that trend line is coming in at or about the 112.80 mark. So when we look at this, we can see that the major indicators from VantagePoint are struggling to tell us that we should stay long here. We've had a few decent long trades last week, but now we have to really question whether there is further upside on the euro based around the technicals, the intermarket correlations, and of course the fundamentals that I outlined at the beginning of the presentation. So the key vantage point level, that is what we want to watch here very closely this coming week, guys. 113.66. We've closed at 114.02. If we break through the 113.66 area, the euro is likely heading back into the lower end of that trend line, again down around this 112.50 area. But we must break through this. We must break through the VantagePoint 18-day predicted EMA. Now, if we can't break through that and this level holds, then we could see the euro rise, but again, be very cautious of a false break to the upside on Monday. We could see a snap move to the upside only for a violent reversal back down once the market has figured out what's really in that labor report. So again, our indicators from VantagePoint are not overly bullish at this particular time. Our neural index moving lower, predicted short-term predicted difference pointing down, as is the predicted long-term and medium-term predicted difference, and our predicted MACD looks to be ready to cross back down to the downside, and our RSI at 51. So we're holding with a mild bullish tone here, but I think it's going to be, the euro is likely going to struggle. So what you want to watch very closely for next week is, can the DAX 30 and more importantly the S&P 500, can they recover and start moving back up? If they do, that will immediately put downward pressure on the euro US currency pair. This will have nothing to do with standard indicators. It will be an intermarket correlation that will drive it. So if you understand the intermarket correlation, you will understand how to trade this euro US pair. And of course the US Swiss franc, basically an inverse correlation, but the same trade here. And we can see it is, US Swiss franc is a leading indicator here, guys. It's starting to turn higher. Now our key vantage point level there, 96.59. We've closed at 97.18. Very bullish here for this particular pair. So when we hone in on this and we look at it a little bit closer here, a triple EMA cross is trying to complete here. So watch this key level at 96.59. Longs heavily favored there to start the week by midday Monday or early Tuesday. If we break above 96.59, close above this level, we should be able to break through this trend line and start moving back towards our swing highs up in the 99 level. So watch that trade very closely. I think it'll be potentially a very good one for the next week, maybe even the next 2 weeks. Now, as we come into the British pound really, in order for it, we've come right up to our yearly opening price around 147. That is the opening price in 2016 for this particular pair. But we've come up to the area and we failed, so we're starting to move lower. The key vantage point level 144.44. We've closed at 144.21 below this level. Now, if the dollar rallies, just because the dollar rallies, the dollar index rallies, does not mean that the British pound US dollar is going to go lower. There's a lot of positives for the British pound at this time of year. Higher oil prices, the potential of staying with the European Union, all of these are potential positives. So the dollar index can go higher and the British pound US can go higher. Now, another intermarket correlation that will fuel that, of course, is the Euro Great Britain pair. So if the Euro comes under pressure, then Euro Great Britain goes higher, Great Britain US will go higher. So watch that pair very closely, but the key vantage point level at 144, price is going to basically gravitate right around this area, and it's going to, like a moth to a flame, it is going to either try and push above it or push below it. So we'll be watching this very closely. Right now, there is a slight downside bias with the short-term predicted difference moving lower, as is the predicted medium-term difference. And the strength indicator, the crossover on the predicted MACD, is absolutely a problem here for longs. And 42 on the predicted RSI suggests that we are going lower first. So right now, I'm just going to move our trend line over so everybody can see this clear as day. Here is our trend line right now, and that's going to come in at or about the vantage point predicted low on Monday, which would be about 143.50. So watch that area closely. If this trend line can hold, then we will move higher, but I would be looking for equities and oil to also be moving higher to support any kind of long trade or reversal. So again, right now for next week, a slight downward bias. Now, as we get into the dollar-yen pair, we actually have a slight upward bias here. Now, the reason I say that is if the equity markets start to move higher and the dollar index starts to move higher, the yen doesn't stand a chance. It's going to weaken and it's going to push the dollar-yen pair up. So for next week, again, with this pair, we want to watch the S&P 500 very, very closely for a reversal back to the upside along with the Nikkei. And we're looking for stronger oil prices and, of course, the dollar index. Now, the key level we have to overtake next week is this 108.58 area. Been a very stubborn level here. We are closing well below that level, but again, it's a very mixed bag here. Now, the medium-term crossing over the long-term predicted difference, you can see it right here. That can be at times an early warning sign of a reversal, and that's a special indicator in here that I haven't talked about much. But again, it's something I'll watch very closely, which basically means in the medium term, the trend is weakening to the downside. So I would look for a potential reversal while we hold above 106. If we push below 106, the equity, the S&P 500 pushes below 2020, then the dollar yen is going to go into basically free fall. I think that there's a less than 50% probability that that's going to happen next week, but the key thing here, guys, is know your levels. If you know your levels, then you know how to trade them and how to react to them. You don't need huge stops. You just need to know the critical levels for next week and the critical drivers as to what can happen. So for now, again, watch this 106 area, 105.90 area like a hawk, and we look for a reversal. When I look at the potential reversal, I see a short-term crossover conflicted with the neural index, and a number of these indicators are coming out of heavily oversold territory. A lot of this points to a reversal. All we need is a trigger to set it off. That trigger will be a reversal in those equity markets, to be very clear. So keep an eye on that. As we come into our US-Canada pair, this one with my own direct clients, we've been getting long most of the week on this one. And again, we see a triple EMA cross is fresh. We've finally broken this trend line and we are pushing higher. The key vantage point level we watch for next week, 127.62. Very bullish close at 129. Now we are going to come into some resistance up here at this former swing high around 129.80. Be careful around 129.80 because these swing highs carry a lot of weight with price action based traders. The intermarket correlation here that's going to drive this one to the upside is again that stronger US dollar. We've had the Canadian non-farm payroll number. It was not a good number out of Canada. There's very little reason to be buying Canadian dollars, especially with the horrendous Liberal government that's in power now. The spending has gone crazy from a $10 billion deficit to a $30 billion. It's a mess. So the Canadian dollar, under the Trudeau government, Trudeau Jr. is Trudeau Sr. We all know he was probably the worst prime minister in history. His son is probably not going to be a lot better. And what's going to happen is they're going to spend. So when the market sees somebody like this spending money they don't have, it does not usually bode well for the currency. So we'll keep an eye on this right now, but if we can break through the 130 level, we are likely going to have a pretty quick run back up towards this 132 area. So keep an eye on that, but right now, longs heavily favored here on a pullback between 128.54 and 127.62. That's a very good buying area for next week. Now, as we come into our Aussie and New Zealand pairs, they do not follow the dollar index to a positive correlation. Now, if the dollar index rises, that doesn't mean that the Aussie and the New Zealand currency are going to weaken. In actual fact, it could be the exact opposite. So we know that the Aussie has a high correlation to the equity markets, specifically the Nikkei and the S&P. So if those two major global indices move higher, then chances are the Aussie will recover and the New Zealand could recover also. Now, we are getting a little overextended here. You can see we're negative 150 on the long-term predicted difference, and the predicted MACD is also getting a little bit overextended. So if nothing else, I think we could see a corrective move back towards the 75.68, but the only way that will happen is if the global indices, and I want to stress this, the global indices, if they recover, then that's exactly what's going to, then the Aussie will recover, the New Zealand will recover. So that's what we're looking potentially to happen, but Aussie is not a very trustworthy currency these days, based on the data, the CPI data, the RBA, the dovish RBA. It's a very shaky pair on longs. Indisputably, it's done fairly well in 2016, but when we look at it from 1 year ago, it was actually the Aussie currency peaked in May of 2015 and plummeted from 82 all the way down to 68, a vicious move to the downside, which was a very good call by VantagePoint, I might add. So for now, we just want to be very careful with adding to further shorts down at this level if the equity markets recover. So if the equity markets don't recover, then basically that's the nail in the coffin for this particular pair. It is going back into those swing lows. So watch the equity markets, and gold for that matter, very closely. Now, as we come into our final pair here, the New Zealand US, we're 68, the 68 level here, guys, 68.20, particularly the 68, this swing low. This is a very, very crucial level for this pair. Now, if we lose the 68 level, we are likely going back down into the 67, maybe even the 66 or 65.80 area. You can see we've got a fresh triple EMA cross. We've got a trend line break closing below that trend line. In most cases, there is follow through on a trade like this. So excuse me, we do have to be very cautious. The key vantage point level right now is 68.92. We've closed at 68.21. What I would suggest, I'll say the same thing I've said to my own direct clients, be very cautious around this 68 level. We could have a violent reversal back to the upside, or we could have a violent breakout to the downside when basically all of your algorithmic systems see this and they all cut their longs and go short. Even if they don't even go short and they just cut all their longs, that will put a lot of downward pressure. So we could see a flash move of 100 pips to the downside within a 24-hour period, and so be very careful of that. But again, I don't hear a lot of analysts talking about this 68 level where it is critical. 68, 68.20, that's the yearly opening price for the New Zealand pair. It's bullish while it's above the opening price, bearish while below. So we're closing right on that area at 68. You can see the closing price at 68.21. So it's basically a make or break period for both the Aussie currency and the New Zealand currency. But these are very difficult currencies to trade because they do react to commodities and they do react to the global indices or the risk on, risk off scenario. So a busy week ahead, guys, but as long as you know your intermarket correlations and your critical levels, I'm confident you will do just fine.